Ladies and gentlemen, good day and welcome to Birla Corporation Q1 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rajesh Kumar Ravi, HDFC Securities. Thank you, and over to you, sir.
Hi, good afternoon, everyone. On behalf of HDFC Securities, I welcome you all to the Q1 FY26 conference call of Birla Corporation Limited. From the management side, we have Mr. Sandeep Ghosh, MD and CEO, and Mr. Aditya Sarogi, Group CFO. I'll now hand over the call to the management team. Post their opening remarks, we will open the floor for Q&A. Over to you, Sandeep sir.
Very good afternoon to everybody, and thank you so much for joining in such large numbers. Though I've been reminded just before the conference that probably our timing is not very correct. It eats literally into a lot of your lunch time, so we'll consider next time onwards whether we should keep it at 2 or a little later. And then keep all of you hungry or interrupt your lunch break. So good to have everybody here, and I will come straight to the brass tacks without too much of a preamble or going around. I sense, and for the few people who have called us, etc., there is a slight dissonance or surprise at the kind of results we have done in terms of what were being expected by many of you as well as in the market. And I'd like to put it in context so that you understand the basis, because this is something we encounter every quarter, irrespective of whether the quarter has gone very well or not so well. Even when it goes very well, sometimes there is an element of surprise there, and when things are not according to expectation also, I think there is a degree of confusion, and that's probably what is not understood very clearly to our mind is the changing business profile of Birla Corporation over the few years. Initially, of course, market took into notice our acquisition of Reliance, but post-acquisition of Reliance, things have also further undergone some amount of structural changes, and at each stage, and it will probably keep happening as we go forward. The most significant one, as you would know, in the last 2 years has been Mukutban and the rapid scaling up of Mukutban. But simultaneously, there have other things happened, like our Chanderia expansion, which had happened earlier. The utilization of Chanderia, although it was high, but now its utilization in the core markets has gone up significantly, and that's linked to how those markets have performed now vis-a-vis some other markets in the neighboring regions. To be clear, what I'm trying to say is Chanderia caters for us a large part of the traditional north, but in our terminology, we look at also Western MP and Western UP as a part of Chanderia's reach, and sometimes it can even, in terms of clinker, not necessarily in terms of cement, we could be even taking Chanderia clinker all the way down to center to if the demand in that area, center and east, is different. So that is something which keeps changing in our company. And similarly, so Chanderia, Mukutban equally also plays not just a role in Vidarbha, but we have always seen this Mukutban as a very integral part of our larger footprint map. I recall, when I first came in, there was a lot of skepticism among many of some of your colleagues, when I had said that, Mukutban, we can actually supplement or Mukutban production and clinker to use as far as, if required, all the way down to the east in Durgapur. And people didn't believe, and some people, as I said, very skeptical or cynical about it. But that is precisely what we have been doing very profitably and very successfully, and that's where our strategy has played out. So the point of my elaborating on these things is there is this whole context of our geographic footprint and how we move things seamlessly between our various units. I think there is probably not a very full understanding of that. The analogy I try to look at it when I talk to our marketing colleagues, everything that today's organization is more like an amoeba. It changes shapes depending on the how the market behaves, how the opportunities arise, and that's how we also operate in our planning. When we look at it very holistically, we are a smaller player. Granted, we are a smaller player. We operate in a limited geography, but within that, this is how we try to optimize. The point I'm getting in here is when you look at realization, etc., our volume mix today, as on today in the last quarter, it stands at 50% in central India. It stands 21% in the east, 16% in the north, and west is 13%. As opposed to, I don't want to take names of some of our peer groups, but if I were to, all of you can guess, some of our peers who are in the same range, if I were to say the first set of people, they have as high as 68% or close to 70% in eastern India, no presence in the north or west, or negligible presence in the west, and they have a southern presence. There are other people who have again got 70% presence in the east, and barely, maybe similar to us, kind of presence in the north, but in the west they are negligible. There are again some other people who are in our league who have almost equal presence between north and central. Unlike us, where the central is heavier, north is less, they have almost. So all these things, factors would be influencing the results, not only in terms of what is there in this quarter, but also in terms of the base effect. And I would I'd ask for indulgence for a minute to just recall. You would know last year, first quarter, east was down, north was down, whereas center was by and large holding on. And for us, although the west or Maharashtra areas markets were not as buoyant, because last year, if you recall, these were all the aftermath of the elections, run up to the elections, summers, everything. Although those markets were not buoyant, our presence there was much more limited because Mukutban had not been ramped up to today's level. So these things have changed, and therefore our, this mix also is constantly changing. So our mix as in last year and our mix today is very different. So this year, though we have a very small presence in the east, we have benefited also from the price increase, etc., which has happened in the east, which is both, although our Durgapur unit is a very small unit, it is very much in Bengal, etc., the market which is there. Durgapur produces, as you know, slag, cement mainly. We have a premium brand there, Unique Plus, and that has done very well. And then Bihar also has been a market which has been on an upswing, I wouldn't say upswing, have been upbeat due to all the things. But there, Bihar, we have a slight disadvantage because we don't have a grinding unit there as compared to many of our peers. So we have to service them from Maihar and Satna, and sometimes we are therefore subject to the vagaries of the logistics system. So taking all these things into account, how the situation is fared. Last year, again talking of our central region, if we were to see in our markets between center region, there has not been too much of a price change between Q1 last year to Q1 this year over there. Or even if we were to compare Q4 of last year to Q1 now, there has been a drop there, but it's a marginal drop. It is not a drop of a very significant level. I think it would be it's about 2. On the whole, there is 2%. About a 2% kind of a thing. On the whole, we have seen. But we have tried to hold on to our central prices, as we will talk later in greater detail. You will see in terms of how we have further buttressed our premium portfolio over there, how we have increased our blended cement percentage there, which we were in the previous quarters, we were forced to sell a lot in the non-trade, which we have reduced dramatically. We have reduced our OPC dramatically, taking up our, blended cement and everything together. And that is how if you were to look at it from a realization standpoint, that is how things have panned out. Where we have had a problem this quarter is we had two extended shutdowns in Mukutban and Maihar. These shutdowns were planned shutdowns, but their period got extended due to some unforeseen thing. In Mukutban, there was heavy rains in that area. In Maihar, we faced certain problems, so those got extended. And having had a very strong quarter in Q4, we were actually short of clinker, maintaining, because our ambition of the plants was very high. As you know, our plant in our core areas, our plants all operate at full capacity, full throttle, so we were short of clinker. So we had to purchase a lot of clinker from the market. We purchased maybe about a lakh tons of clinker from the market, which is 1 lakh ton we have purchased, and in fact in the previous quarter we were actually there was a net sales which was happening over in the previous quarter.
Immediately preceding.
Yeah, immediately preceding quarter is what I mean. So there is a delta which has hit us in terms of the clinker cost, which you see reflected. If you are seeing our EBITDA per ton being lower than maybe what some of you have estimated, a large component of that comes from the clinker cost impact which you have had, especially in our central region, which is our core market, as I said, about 50%. Equally, when we had a problem in Mukutban area, obviously that took some jolt on the sales. In the Mukutban, we could have done much better in Mukutban region, given we had already ramped up, we had a market presence over there, and some markets around it were also doing pretty well. So we lost something over there. So between these two things, I don't want to put a number, but you would be able to guess the 715, if it is, because all of you had your own estimates, could have been much higher had it not been for these two, the negative hit.
And slightly lower realization.
So therefore, if I were to compare the two, the largest contributor of this results is the marginally lower realization, which is a function of, as I said, the central region prices being somewhat lukewarm compared to what has happened in the north and what has happened in the east especially. So those who have a higher presence in the north obviously have benefited in the north prices. Those who have presence in the east, we also have a small presence, so we have also benefited, but albeit because our plant is small, our impact what we have got is not as large to compensate for this clinker loss, etc., which I was talking of in the central markets, where we had to buy clinker from many of our competitors nearby, whereas, as I said, in the previous quarters we were net sellers. We were doing, there are many places which was swapping situations, but net we were sellers in some markets. That has changed, and that's impacted the overall scene. So these two per se should be able to explain any, as I said, any deviation which you have in your mind between our performance. But we as a company, as we have stated in the press release, today we think we are we are positioned on very firm footing, standing on 4 legs, very strong, and with a flexibility which is something which we keep on highlighting everywhere. And this gives us the confidence of now moving forward with our plans, as again there's no change. We have stated our growth plans earlier, so we feel we are able to move forward with far greater confidence, and some of it you would have seen reflected in terms of our longer term plans, though this is not related to our caution to add to anything specific, but many people have observed our acquisition of some mining rights of late, etc. So these, as you see, are building blocks which are falling in place for delivering whatever our commitment is to our stakeholders and to the markets going forward by 2027 and then by 2030. I would probably rest here and invite questions which will be answered not just by me, but I have with me, as usual, our Group CFO, Mr. Adit Sarogi, our Chief Controller, Mr. Arun Agarwal. We have got Rajat Prushti, our CMOP, Chief of Manufacturing and Projects, and Mr. Of course, Kalidas Pramanik, our Chief Marketing Officer. So they will all, join in to respond to your questions. But as always, we have been totally transparent, and that's how we will be with you. There is nothing to hide. We don't find anything that we need to be defensive about, because that's how things are as it stands. And we are confident of the future. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Shravan S. from Dolat Capital. Please go ahead.
Hi. Thank you, sir. Sir, whatever you have given, so just to try to understand in terms of the profitability, so given from 1,000 odd rupees EBITDA per ton, now we came to 715 odd. So given both on the pricing front and then the cost front, how one can look at this profitability from this quarter Q2 onwards, or maybe for full year, any sense how one can look at? So both you can say the current prices versus what it was in the Q1, and from the cost perspective, any further cost reduction, how one can look at the profitability.
See, first of all, before I hand over to Mr. Sarogi, I would like to make 2 comments. The 715, which I have already underscored, there is a certain, I would call it, abnormal loss, which is on account, as I said very clearly, largely on account of our clinker shortage, and therefore purchased clinker, which our Maihar plant, I would not be able to tell you specifically, but all of you are very knowledgeable. You know, our Maihar plant clinker is one of the cheapest clinker production which we have within the company. So is Mukutban. It's one of the cheapest sources of clinker, not only in the company, but some of them compare with the best in industry. As opposed to that, our own variable cost of clinker, if I have had to purchase clinker from our competitors, who in a normal situation, they would not be also in having a huge surplus, so they obviously would not give it to me at any great discount. So the delta is very significant. And that delta is what has given us a hit in the results. So there 715, if you were to, since you're comparing from 1,000, a large component of that would be coming from this one single factor. Then the second factor is, which we've already said, there is in our case, in a weighted average basis, we haven't had a spike in the prices which people in the east and people in the north have benefited from. People in the east and south are not taking into account, because south we are not present, but east and north. And when you do peer comparisons, when you do industry thing, obviously the south factor will play in the results. And some of our competitors who've got a strong south presence, obviously they've benefited from that. I told you, we have among our people some people who have as high as 12% of their volumes coming from the south. Others have close to 10% or more, or 25-26% also in the case of one particular player who also are in our league. So obviously their realizations would have been higher. In our case, a combination of our central region being slightly depressed, but also when we look at a Mukutban, that area, the overall realization is much lower than if you were to compare with the east or north, because the prices there are at a lower peg. So when you do a weighted average thing, our overall average realization comes down. So that has also had an impact. So these two impacts are there. Now, if I were to talk going forward, what you will see, what we can predict, obviously, I don't see our clinker shortage situation continuing. Okay, so we are not buying any clinker just now, and I don't expect to buy any clinker going forward, either in Q2 or Q3, Q4. We are quite self-sufficient in our whole clinker position, so that is not going to happen. So whatever amount you're assigning on account of the clinker thing, that you can take out straight away. Rest in terms of prices, everything is transparent before you. The good story is, as all of you know and have been commenting in your report, there's some background noise coming from some. Hello?
Yes, sir.
Mute the mic behind. So as you will see, the prices, I think overall between Q1 to Q2, except what I am reading in the south, there has not been any dramatic change. I can't predict, I can't do crystal ball gazing as to how it will behave in the coming months. It depends on monsoons, depends on various other factors. But I'm not seeing any huge dark clouds on the pricing front. So those factors remain static. What will change for us again, while I told you about the clinker element in center, that won't be there, but we'll also have Mukutban, which I told you we had lost a little bit of volume in the last quarter. That will get corrected. We will get back to our plan of ramp up, and we believe in the center we will add to our volumes and market share because of some debottlenecking and other things which are happening, as all of you know. So that should give us. So those will change. Some of the other factors which is true for us could be true for others also, in terms of reduction in non-trade sales, etc. But there are also players we know who are in our direct competition who are highly OPC focused as well as non-trade focused. Compared to them, the more the market develops, we would be in a better position to reduce our non-trade component and increase our blended cement, going back to the kind of levels we were operating in the past.
Sir, couple of data points for Q1, if you can share. Mukutban volume, lead distance, kcal cost, and capex and net debt.
Who is speaking, please?
Sir, Shravan here from Daulat Capital.
To Mr. Sarogi and Mr.
Mukutban volume was 6.6 lakh tons. The fuel cost million kcal was 46. Capex was around 100 crores. And what else?
Please,
sir, fuel cost is...
Lead distance was 340 average total lead distance.
Sorry, lead distance, sir, you said 340?
342, yeah.
342. And kcal cost, you said 142?
146.
146. And capex is 100 crore?
Yeah.
Okay, thank you, sir.
Thank you. The next question is from the line of Jyoti from Nirmal Bang. Please go ahead.
Thank you, sir, for the opportunity.
It's not. It's an opportunity for us. You don't join the call often, so that you have joined, we consider it to be our opportunity. Thank you.
No. I mean, yeah, a bit disappointed in terms of the numbers, but I hope we know that the second half is going to be a very good, year for the cement industry. While this quarter has been almost like a 10% YOY, my concern is that with your limited ability to cater to the market because of the capacity, do you think there's a possibility that in third quarter you may lose market share even if you're running, running at 90% utilization levels? So, and with this first, yes.
Two things. One is we don't run at 90%. We run at much higher than that. Okay.
I know that 90% plus.
Okay.
So then in that case, plus.
Okay. And we are, as I said, there'll be some more changes which are happening with the pipeline, which will make it plus.
Okay.
But this will not put us in the league of people who have expanded their capacity and who are continuing to expand their capacity. That is something which we are very conscious of. But that's why our focus is not really what others are doing. They have their strategy. They have their own, fights to play in the market. We focus on our strategy, and that has been, as you know, focusing on our value share. We are not, at this juncture, we are not worried about volume share. We as much, because obviously since we have a limited volume, so we would like to improve our value share wherever possible. And there is no hiding this fact. There is nothing to be, as I said, defensive or apologetic. We have certain constraints, but we feel that we do have opportunity to increase our value share. I was personally quite, in the presence of my colleagues, I must say, I was personally quite happy and flattered, if I may say, that some of you who went, I saw some of the analyst reports which coming in from field visits, which have now, for the first time I found, they've acknowledged openly that our products, our Perfect Plus is operating at par or higher than some of our A category competitors. So that should reinforce, apart from the percentage figures which we give you in various markets where we are operating with more than, in UP we have 3 premium brands, Perfect Plus, Ultimate, Samrat Advanced. Each has a segment. So that is how we have been doing in terms of moving up. In this quarter, Mr. Pramanik and his team have further increased the premium component in the Mukutban region, where we are selling, increased our premium percentage from what used to be about 40% of sales to now 50% of sales. And again, I hope some of you who go for field visits will realize that our products are selling no less than the erstwhile top brands in these markets. So we are focusing on that. We are aware of the Jyoti. We cannot compete on market share, volume market share with people at this point in time, because we haven't set up new capacity. Even if we are setting up new grinding capacity, we don't have additional clinker coming in immediately. So we have to make do with what we have. So we focus on our strategy, because through that our focus is to give the maximum returns to our shareholder with whatever assets we have, not only sweating them but getting the maximum return out of them. And again, to repeat what I have always emphasized, we as a company have always believed from that the assets are not just your plant assets, not just your major part of the asset, which is not always recognized in this industry, is the go-to-market assets, which is your sales and distribution, the channel, plus your people and obviously your brand and marketing strengths.
I agree, sir. In fact, I would rather look at Star Cement, because in this situation where even Star, while it has actually increased capacity, but I feel that they will also have very limited presence Yet, even if the current capacity, whatever little debottlenecking we do, if we maintain a beta pattern of, let's say, 1,000, that creates a lot of value for the shareholders. That's all I want to say, that while we may be limited for the next maybe couple of months, but if we continue to maintain a very healthy EBITDA per ton, that alone speaks volumes about the company's performance. That is all I would like to say.
Jyoti, thank you, but that's the only reason that's our reason for existence. We will not give up EBITDA per ton for either lack of will or lack of, you might say, competence.
So full year, can we expect that you will recover in the next 3 quarters and we'll be close to ballpark of, let's say, 1,000, or we will be close to 1,100? Is there any estimate or benchmark you've kept for full year EBITDA per ton for the company? And what is the amount kind of cost savings that you expect in the next over this year, which you'll achieve?
Jyoti, you know us for long enough to know that we don't commit numbers in terms of future EBITDA.
Yeah.
Sometimes better than us what we are going to deliver. So I would go by your judgment rather than me hazarding a risk on the. Okay. Or you can give me a separate call and tell me what is your estimate of EBITDA for the rest of the year. I'll keep that in mind, or target if you said for me. Thank you.
I'll do that. Thank you so much, sir.
Thank you. The next question is from the line of Saket Kapoor from Kapoor & Co. Please go ahead.
Saket, you don't come for tea, but you join up here and ask questions. That's not fair.
Yes, sir. No, sir. I will make it a point, seek an appointment, and will be there before the AGM, sir. Thank you, sir, firstly, for acknowledging me, and namaskar to the team. Sir,
you have another, it's unfair advantage over everybody else. You also attend the AGM. So today you should not ask too many questions.
Okay, sir. Sir, the first part is towards the employee cost. When we see on a quarter-on-quarter basis, that has also gone up. So any one-off item in it, or is it the annual increment that have been factored?
These are all function of fixed costs, are a function of volume also, na boss. So when your volumes have suffered, obviously fixed cost absorption will go up. If your answer is there, that I don't think,
apart from the usual increment.
Apart from the usual increment, nothing really has happened. You have a better idea about where we are placed on the remuneration brackets. It is just a function of volumes, and you will see changes in that as we go forward.
Okay. And sir, for the capex, you mentioned 100 crore for this quarter. What have we budgeted for the entire year?
I think in the last call we had mentioned about 1,100 crores.
In the ballpark of 1,000 we had said. So no change.
No change to what we had said last quarter.
Sir, the number I missed. 1,000 crore you mentioned?
Around 1,000 we had said.
You can check the last call's transcript.
We are one company, Saket, you'll appreciate we don't change our position frequently.
Okay. So, sir, keeping that into account, what is the current net debt number, our current year maturities, and what should be closing the year in terms of the debt levels?
Our current net debt is around 2,300 crores. And we expect to close in less than 3,000 crores.
Under 3,000 crores. And last question is on the jute part, sir. In your release, you mentioned about the cost and the profitability to be best in the industry. And I think so you also mentioned the impact of higher raw jute prices. So what steps are we taking, and what are we eyeing in terms of being best in class in terms of jute? And what can we expect from this segment going forward, sir?
Jute, as we said, we want to be the best in class. We are, as you know, the oldest jute operating company, and this is our flagship company. And what I always emphasize, the other companies, some of them may be old, but none of them have remained with the same owners for this length of time. Everybody has undergone a change. So we have a very different kind of not only a commitment, but our relationship with this business. But what we are seeing today, Saket, first of all, jute, there is a lot of, low, I wouldn't call it low-hanging fruit, but there is a lot of, things on the ground which can be swept aside if you were to just simply change your manufacturing practices, your efficiencies, and we have already started getting benefits of that. We are trying to reduce our dependence on government orders, improve our the non-government orders both in domestic as well as we have said, there is a new focus we are putting on exports. But along with that, there is some modernization going on, getting more the modern looms and increasing the efficiency there. We are working on the raw jute and a whole host of things. The pricing which is going up in the market, that is not really under our control. That we can only try to do best by sharpening our buying practices, buying policies, where also we are having a much more focused commercial approach.
Right. And lastly, sir, if we take the volume, how should the volume shape up for the balance 3 quarters in terms of the volume growth trajectory, if you could just articulate for us?
Nothing changes, Saket. We have been giving the annual indication. We have given you 6 to 7% kind of a thing. That's what we will maintain. We will maintain that guidance.
Okay, sir. Thank you, sir. I joined the queue and all the best to the team, sir.
Thank you. The next question is from the line of Kunal Shah from DAM Capital. Please go ahead.
Yeah, hi, sir. Just a couple of things. So one, on a couple of previous calls and this press release as well, you highlighted about prices in Central India being a bit depressed. Now, just wanted to get your thoughts on, how would the supply-demand dynamics play out in our micro pockets, once JP is acquired and ramped up. Now, do you see this pricing pressure to sort of sustain over the near to medium term?
JK or JP?
JPS, Jayaprakash.
That's still some way off. But the central market operates at 3 or 4 levels, segments. And the growth also comes from 3 or 4 segments very clearly. There is going to be a lot of infra-led growth, which is happening, and where people who are much more dominant in the OPC segment and who go through in the non-trade route, for them, that's an area. But at the same time, if there are investments and economic growth happening in those places, we also see a clear trend towards premiumization and growth of in the individual house builders as well as in the retail segment. Really, we are seeing an uptrading happening in those markets. Some of them you have commented when you have visited Western MP. But similarly, if you go to UP, which you mentioned is you're due to go, you'll find all these markets. There is a huge uptrading which is happening there, and we would like to operate largely in that cream over there, and so that's why even in this quarter, if you were to look at how we have maintained our net realization, we have been able to maintain, I can't give you comparative figures between us and some of our peers in the relevant, to use your very nice term, micro markets. Our realization we've been able to maintain basically on our premium, the premium we command. And that also gives us stickiness in the volume there, and retains our market share in those particular segments. The real tussle will happen, I think, at the bottom of the pyramid as new capacities come up, because people have to sell more on non-trade, on OPC, and that's where you see, obviously, that also impacts the retail segment, but when you're higher up on the value chain, you're somewhat insulated.
Got it. And just one related question then, in this backdrop, like how do we plan to retain our trade level share? Like given we have limited capacity expansions for the next 2 years in these home markets, so will we just keep focusing more towards the trade and, backtrack from the non-trade slash OPC segment, or, how to think about this?
We have said this again and again, Kunal, that trade is our bread and butter. Okay, that has always been our situation. If you go back, not just today, even earlier, we have always operated at plus 85% on trade, as well as on blended cement, sometimes going even higher. So we are not backtracking on the non-trade. We sell non-trade only when it is necessary. Otherwise, we are quite happy to leave the non-trade for those who are interested in playing that in that ground. We choose our, the price segment, the ground which we want to play in, with what we have. So, and to say that for 2 years we will remain static is perhaps not very correct. You will see, of course, our new capacity of Vaiher will take 2 years to come up. But while that is happening, even within our existing mix, you will see both a qualitative change and some amount of, innovations, debottlenecking, or some other tactical moves which will, give us some edge. Obviously, we cannot be competing with somebody setting up a new plant or reactivating a new plant. But within this thing, what I keep referring to our value share, we will try to maintain that.
So Kunal, just to add to what Mr. Ghosh said, our share of blended cement, the proportion of blended cement this quarter was 89%. That is up from 82% on a sequential basis. So that is the kind of change we have been able to effect. And coming to the trade sale again, in the immediately preceding quarter it was 72%. From there we have taken it to 78% in this quarter.
And that change of 82 to 89, I hope all of you will recognize and appreciate it's a reflection of our brand strength, our marketing, sales and distribution strength. This is something I like to emphasize, because anybody wanting to, turn the switch on and off are not able to do it so easily without sacrificing their brand premiums or increasing discounts or whatever.
Understood, sir. This is very helpful. Thanks a lot.
Thank you. The next question is from the line of Sanjay Nandi from VT Capital. Please go ahead.
Hello. Hello. Good noon, sir.
Yeah.
Thank you for the opportunity, sir. Sir, in the beginning, you just mentioned that we have bought 1 lakh ton of clinker for this quarter due to shortage of clinker. So, could you please guide us, like what price did we buy, or what is the average price which is running on as on date for the clinker? If you buy from outside?
We can't divulge the exact prices, Sanjay. We have given an indication, and that's something very easy for you guys to find out. A couple of calls, you'll get to know what are the clinker price sales today.
Sure. Got it, sir. So that's from my side, sir. Thank you so much, sir. Wish you all the best.
Thank you. Before we take the next question, we would like to remind the participants to press star and 1 to ask a question. The next question is from the line of Rajesh Kumar Ravi from HDFC Securities. Please go ahead.
Hi, sir. In this quarter, obviously, you delivered very strong volumes, gaining market share, and you also shared the regional breakup of your, sales volume. We wanted to understand sequentially how were your regional sales mix in Q4 to understand, this sequential decline in pricing which you have, which is visible in the numbers. Where did this decline come from?
Decline
on a Q on Q basis.
Decline in pricing. We said there are two elements. You see, there is a price mix and the geographic mix. Okay, volume in terms of geography, which happens. So central region is the overall 50% of our volumes coming from center. There, the prices not having gone up, you have to compare it relative to the other regions, and that's how people's things have gone, how they have gained in the overall mix. So central region is where we have, we said about -2% or so is the price hit which we have got. But other regions where it has gone up, which is east primarily, we have benefited, but our volumes there is pretty small. So we have not obviously got the same benefit as other people. In Mukutband area, the loss is essentially of volumes, so there has been marginal improvement in prices in Maharashtra and in the West markets in the last quarter, but we have obviously not benefited totally from this because of our this thing.
Sir, in Q4, what was the volume mix? As you mentioned, 50% central. In Q4, what was the central mix?
I don't have the exact numbers, but our west would have been slightly more.
Yes.
East would have been slightly lower. I think about 18 or 19% would have been east. West would have been higher at about 14 or 15%, I guess. And north would have been by and large around the 16% or so. If the last quarter we had done very well in the north.
Yeah.
Mm-hmm. And how much has been the incentive accrued in Q1?
23 crores, Rajesh.
Okay, 23 crore. So versus 40 crore in Q4, we have accrued only 23 crore in Q1.
41 in Q4.
41, right. And so this depreciation 10% decline year on year, what led to this fall in depreciation expense?
10%.
There is no specific reason as such, Rajesh. Maybe because there was shutdown, the running days was less, maybe because of that there's small decline.
Second, depreciation on limestone, which has come down, and second of all, many assets have reached this 5% limit. So that depreciation we have stopped charging as per book.
Okay. And the lastly, the progress of the clinker expansion and Kundanganj project. What milestone we have achieved so far on the Maihar expansion clinker line, and what is the status on the Kundanganj commissioning?
On track, Rajesh. There is nothing very specific to report at this point in time. Maybe when we are having the next con call, you will hear more from me.
Okay. Answer this out of 1,000 or 1,100 crore which you are targeting for this year. Q1 you mentioned you have spent 100 crores. So 900 odd or 1,000 crore you would be doing it the subsequent 9 months. And where would they be allocated into? What buckets?
We don't have that breakup
Lot
right
of it
now,
is
but it will be mostly project and some sustenance, a mix of project and sustenance capex.
Some of that which is in pipeline will get capitalized, not yet been done. So some of that will come from there, and few of them are from, as Mr. Sarogi mentioned, are from sustenance capex, because we have a very confident
sure. And lastly, before I move on, this clinker purchase which you did, what was the additional cost which would have put on the books in Q1, which may not be present in subsequent quarter, versus your own production cost?
Rajesh, I mentioned we cannot give the exact specific figures, but you have a fair idea. We've given you as much of a hint that Maihar is our lowest cost producer.
Yes.
And opposed to that, the people I buy from, their cost itself is much higher. Again, I don't have to tell you the names or the kind of thing, and they obviously in that situation would not give me at a great discount. So it is a fairly heavy charge.
Understood, sir. Thank you. I'll come back in queue.
Thank you. The next question is from the line of Ashutosh Mudarka from Choice Institutional Equities. Please go ahead. Mr. Ashutosh, are you there? As there is no response from the participant, we move on to the next one. The next question is from the line of Saket Kapoor from Kapoor & Co. Please go ahead.
Saket, I thought your next question would be on 15th of September at the AGM. Why are you?
Sir, for the WHRS, what is our current capacity and what have we outlined for the incremental capacity and the savings thereof, sir, if I may ask, sir?
So the current capacity of WHR is around 40 megawatt, and we have planned for any other modernization on these areas with around 10 megawatt more we are planning. So it will be roughly, you can say that 50 megawatt will be our whole capacity once we complete all the expansion which we are planned or modernization which are planned for the existing setups.
Okay, and how much you will spend for the same and payback period?
Those are the things already.
We don't give such specific details, Saket.
Oh, okay, sir. Sir, since you mentioned that there is our Mayer clinker are the cheapest, so if you could just outline to us what was the absolute number impact for the EBITDA per ton going down to 700. Had been a normalized quarter, what would have been this number, sir?
We have said this repeatedly, Saket, in the course of this call itself. We can't talk of specific numbers on this. You have a very educated guess. I told this 4 or 5 times here. We gave you as much as saying that we have bought about 1 lakh ton of clinker. We have said that. You assign your numbers, you'll get you.
Correct, sir. Thank you, sir, and all the best to the team. Thank you.
Thank you very much.
Thank you. Ladies and gentlemen, we will take that as our last question. I would now like to hand the conference over to the management for closing comments.
There's one more. Motilal Oswal, I think.
Okay, sir.
Prathamesh.
Next question is from the line of Prathamesh Dhake from Motilal Oswal. Please go ahead.
Hi, sir. Just one small question from my side. Wanted to check the update on the upcoming capacities and what will be the capacity installed by the end of FY26 and 27.
We have given the guidance in the last conference call. You can have a look at that. There is no change in the guidance that we are.
Okay. Got it. That's all from my side.
Ladies and gentlemen, as there are no further questions from the participants, I now hand the conference over to the management for closing comments.
No, thank you very much for participating in such large numbers. Hope we have been able to answer some of your queries and doubts. Rest of it, while we have not been specific, that's part of the policy, but I guess all of you have a fair idea on all the questions there. The last question which was asked, I would only like to comment that you don't see a clinker capacity coming before 27. It is all the major change you will find is that Kundanganj new line, which is going to, that is going to get commissioned and in the course of the year. Thank you.
Thank you. On behalf of Birla Corporation, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.